Hey everyone, Chris Hobart here, the Wealthologist. All right, I want to ask you something. Have you ever opened a gift, all excited, only to realize that there's a catch? My favorite is, congratulations, you won a free vacation. Just pay these hidden fees, taxes, and then listen to a 6-hour timeshare pitch. That's kind of like what's happening right now with 401ks and IRAs. For years, we were told to max out our retirement accounts because we'd save on taxes now and pay less in retirement. But here's the problem. For many, retirement is here, and the tax bill, it's bigger than expected. It turns out a lot of retirees are paying higher tax rates now than when they were working, and nobody warned them. This is the tax bomb that no one told you about. Right now, there's over $23 trillion sitting in tax-deferred retirement accounts, IRAs, 401ks, you get it, things like that. Now, unless you planned ahead, Uncle Sam, and in some cases your state, they get a huge slice of that pie. But what's the worst part? I know what you're thinking. That is the worst part. No, it's not just about paying taxes. It's actually how these taxes creep up on you in ways that most people never expected. So, there's 5 different ways that this tax time bomb can blow up in your retirement. First, your tax rate might be higher in retirement. Kind of touched on this, but back in the 80s and 90s, the financial advisors said, don't worry, you're going to be in a lower tax bracket in retirement. But fast forward to today, and guess what? That's not always true. Why? Because required minimum distributions, or RMDs, they force you to take out money even if you don't need it. Now, that extra income can push you into a higher tax bracket than you were when you were working. Number 2, RMDs can make your Social Security more taxable. Here's that fun little surprise. Once you start withdrawing money from your 401k or IRA, it can actually trigger higher taxes on your Social Security benefits. And because the IRS hasn't adjusted the income thresholds for inflation, more retirees are paying taxes on their Social Security every year. What about number 3? Medicare premiums could skyrocket. Have you ever heard of what's called IRMA? No, not your great aunt. It's the income-related monthly adjustment amount. Now, if your RMDs push your income too high, you could get hit with extra Medicare premiums, up to $6,000 per person per year. Yikes, right? Now, number 4, your kids won't get the tax break you expected. Now, remember when we thought we could pass down our 401ks and IRAs and our kids could take small withdrawals over their lifetime? Well, in 2019, the Secure Act changed the game. Now, most heirs have to empty inherited retirement accounts within 10 years of your passing, which could push them into a crazy high tax bracket, specifically if they're still working when they inherit that money. 5th thing, the stock market could make it worse as well. Here's something no one planned for. The stock market has been booming, right? Now, that sounds great until you realize it means even bigger RMDs and therefore bigger tax bills. And if your account keeps growing faster than you're withdrawing, well, guess what? Your taxes, they keep climbing. So how do we diffuse that tax time bomb? Good news is I'm not just here to scare you. I'm here to help you. So let's talk solutions. First and foremost, consider Roth conversions early. If you've got kids, talk with them about this, because moving some money from a traditional 401k or IRA to a Roth can reduce future RMDs and give you tax-free income later. And you can do this at any stage of your life. So if you're already taking RMDs, you can do this. Just got to follow the rules. Second, don't overload on traditional 401k contributions if you're still contributing, because you need to balance your savings across taxable accounts. So tax accounts, Roth accounts, and traditional accounts allow you more flexibility in the future. Third thing, strategize your withdrawals. Work with a pro like us to manage your income in retirement to help keep your taxes low. Also, for those of you that are over 70 and a half, use qualified charitable distributions, or what are called QCDs. This allows you to donate your RMDs directly to charity tax-free and bypass some ancillary taxes. Something I love is educate your kids and grandkids. The younger generations can take advantage of things like Roth 401ks, Roth IRAs, and HSAs to avoid this mess entirely, but you may have to be the one to tell them. Look, we all know retirement, it should be about enjoying life, not stressing over tax bills. Now, there's good news. With right planning, you can minimize taxes and keep more of your hard-earned money. And I'm hoping that this video gave you maybe an aha moment. For a lot of our clients, you've already got it, but I want all of you to take this to heart and hit that like button as well, subscribe. And if you're wondering how you should navigate your own retirement taxes, let's talk. Drop a comment, visit our website. I'd love to help you build a strategy that keeps more money in your pocket. Until next time, have a great week.